And with this, we shall begin. Welcome, everyone. Good evening. Myself, Janvi Askaukar, and I would like to welcome all of you guys on the behalf of Samco Mutual Fund. As we begin, before beginning our call, I would like to thank each and every one of you who have joined the call and who have removed their time from the schedule, who are attending right now Samco Flexi Cap Fund's very first annual scheme meetup. We have our whole investment strategy here. Both of our fund manager, Mr. Dhawal Dhanani, a CA with an experience of 5 years into capital markets, our senior fund manager, Ms. Nirali Bhansali, an engineer, an MBA, and 7 years of capital market investment experience. Mentoring both of them, we have our Chief Investment Officer, a CA and an MBA, Mr. Umeshkumar Mehta. And without taking further more time, I would request Mr. Umeshkumar Mehta to take over the call. Thank you.
Good afternoon. So this is our first anniversary call for Flexi, our Samco Flexi Cap Fund. And I know what all that you all are here to hear about. So we will address all that and much more. So very warm welcome and a thank you to each and every one of you to attend our first call. So let's begin. So let's begin with the standard disclosure that we generally have. Mutual fund investments are, just a minute, I will just add. So disclaimer that stocks that we will discuss here are for illustrative purposes and are not a recommendation, and past performances may or may not repeat in future, and investments are subject to market risks. So this slide is all that you all are looking at. This is our yearly performance, and this is where we are. So we are at the bottom quartile, and this is the fact. But if we want, shall we dissect little more these numbers? So if I may, and this is as of yesterday. So these numbers in the entire flexi cap category, there are 39 funds as of today, and this is where we are, and this is our annual yearly performance. But if we dissect little more, if we look into 6 months, so this is where we are rising. And if we go back and if we check 3 months, this is where we are 3 months, and you can take snapshot of all these photos. So what happened? So last year when we closed our NFO, thereafter something happened. A black swan event happened. Ukraine-Russia war crisis occurred, and thereafter, all things, whatever had gone wrong. So last 6 months is where we have seen a major bottom, and markets have been rising. So last full year, markets was in corrective mode because of Russia-Ukraine crisis, because of high inflation, fear of interest rate increase, etc. But thereafter, since last June, July, August, we have seen a bounce back in the market, and probably this is where our numbers are also showing. So when markets have started to rise, our number is starting to show higher and higher number. And if you want to show you, so I showed you 6 months, and and 1 month, this is where the 1 month numbers are. Again, just let me recollect. Today we are here, 1 year return, but if we move a little more, 6 months return is here, 3 month return is still better, and 1 month return is we are somewhere. But actually, is this numerical race, 1 month, 6 months, 1 year, 2 year, 3 year, is an apt way to look at the numbers? Maybe yes, maybe no. No, if we were 125 years, if I take you 125 years back in time, this is not at all a way people at that time used to compare numbers. So when for the first time, when indexes was invented by Mr. Charles H. Dow, and he was the owner of Dow Jones and Company. and an editor in Wall Street Journal. So prior to then, people used to think that stock prices move basis their own reasons. But Charles H. Dow thought that if we create an index, and he created index of 12 large companies, and which he named as Dow Jones Industrial Average. The purpose of making that index was to make a forecasting tool so that they can predict where the prices can go, where the markets can go. That was the purpose where Dow Jones, Mr. Charles Dow had created the Dow Jones Industrial Average as an index. But today, where has this entire index industry gone? So 125 साल बाद वो Charles Dow, when he realizes that this on this planet Earth, how index they have made that as an industry. Index today is an industry. People are mimicking index and charging a fee. They are managing assets. People are charging fee by comparing fund performance with the index, and they are charging a fee. Even stock exchanges, they are using index as a trading instrument, and they are making fee. 80% of earnings that exchanges earn are on derivative. So over the past 125 years, when index was first invented, this is how index has been used. And today, what we see is because index is an easier way to compare, majority of people would like to compare index and the returns of the scheme. And this is how world has evolved. But let's be honest. This is one way, and obviously we will look at it. But the another far better way is to look at the underlying portfolio, to look at the underlying assets, to look at the underlying businesses. Do they collectively, when they score the number? So we need to understand what those underlying portfolio are, and that is where we will be able to have high conviction that will this portfolio generate returns in the long term. So obviously that we will cover, and Mrs. Nirali Bhansali will cover all that. But now let's look at what the current world is looking at index, and which you all are also looking. So now let's go to the next part, and let's understand why is the kind of return that we have and where we are. So these numbers are available in our even fact sheet. 1 year of return since inceptions, the benchmark return, etc. And this is where we are. As I told you, you all know that we are in the bottom quartile on the 1 year performance. But 6 years, 3 months, and 1 year, we are getting better and better. So this, to my mind, is a correct way of looking at our fund. If we want to compare ourselves, we should compare with the other growth-oriented portfolios or growth-oriented benchmarks. Comparing straight away with so many stocks is a different thing. But when we do a like-to-like comparison, I think that's a far more saner way to look at it. So if we look at last 1 year return, Samco Flexi Cap, if you all know. But when we compare Vanguard Russell Growth Index, or for that matter, S&P 500 ETF, growth ETF, so there are thousands of companies world over, and they track returns of growth-oriented portfolio. So this is where we are. We are still better than the global benchmarks, or those who run the growth-oriented strategy. So this is where we are, and this is how one should look at a growth-oriented portfolio for a proper comparison. So now let's understand Warren Buffett. So Warren Buffett also, these are 58 years of Warren Buffett's return when he acquired control on Berkshire Hathaway. So at times he has underperformed. The red line below you see, and these are all annual underperformances. And the green, if you see, they are all annual overperformances. So any asset manager, or for that matter, any investor, those who have high active share. So active share, I mean, the portfolio which is widely different from the index, composition and weight. So Warren Buffett also works with an 87% active share. I repeat, Warren Buffett today, as on 31st January 2023, has an active share of 87%. Samco our Flexi Cap scheme, has an active share of 90%. So we are going to have the period of over and under performances because we are widely different from benchmark. So benchmark may do whatever benchmark wants to do, but it is our underlying portfolio that sometimes will perform better, far better, and sometimes will not perform. And this is also what Warren Buffett, 58 years of history, I have shown you. And you can all take screenshots of all these things, which will help you understand, where we are in terms of our performances. So now let's come to the reason why. So why we were, our performances was around 8% in terms of red. So let's understand the reason. So when we closed our scheme last year, and thereafter in February, the Russia-Ukraine war started. So no one on this earth had predicted that war. We are not God. So when that war began, so commodity prices started to move higher, inflation started to move higher, and entire valuation dynamics got a hit because the cost of money became costlier, and therefore central banks across the world started to increase the interest rate. The blue bars that you see are the increments. So left side is US Fed. So they increase the interest rate from near zero to around 4.5%, around 5%, below 5%. In India, our RBI also increased interest rate, and to currently it's at around less than 7%. It's around 6.5%. So we also had an increase. So when interest rate increases with such high velocity, what changes is the valuation dynamics. So now let me explain you with practical example. As I told you, we are growth oriented. Our strategy, all our portfolio underlying stocks have a growth bias, and the other school of thought is value. So now let's understand with example, and this you can take screenshots as well. See, when growth oriented stock, when the interest rate or cost of money, when it increases by 4%. So this is the assumption that we have made, that a year prior to 2022 and 2022. In 2022, the entire dynamics changed. Interest rate was increasing rapidly. So we have assumed a 4% increase in interest rate. So when in DCF, in discounted cash flow, when we discount the cash flows through a discount rate, so that discount rate has increased from 10 to 14% in both cases. So in that scenario, the cash flow of growth stock will fall by 66%. The intrinsic value of a growth stock will fall by 66%, and the intrinsic value of a value stock will fall by 35% when there is a 4% increase in cost of money. So this is what we have seen in United States of America. Interest rates have increased from 0 to around 4.5%, and it is likelihood that by March this month it can reach to 5%. So the cost of money has increased by 5, and when we discount that, the growth stock will have a far higher beating, because in growth stock the terminal value has a larger value, and when you apply a high discount rate to discount the cash flow, the intrinsic value decreases. So this is what you have seen by way of simple example, and this is what has actually happened world over actually. So 66% decline in growth stock, and value stock declined by 35%. So now let's come to the real world scenario. So this is Vanguard growth ETF and value ETF last year. So growth ETF, so all those growth oriented stocks are down massively. They are down by 22%, and value is down by plus by around 2%. So I'll explain you the reason mathematically. When interest rate rises, there is a sharp cut in the growth stock, and where we are, and this is Vanguard. These are thousands of companies tracked across the world, and the growth index is down by 22%. But mind you, we are down by around 8.5%. We have fallen far less than the global averages, than the global strategies who run growth-oriented funds. So now let's come to a bigger picture. So in long term, growth gives outperformance. And if you see after COVID, the growth-oriented stock had got a phenomenal run. The yellow color line that you all can see. Thereafter 2022, we have seen a massive correction. But at the same time, value stocks have done a catch-up. So they have moved higher. But now if you see, the gap is reducing. There is a massive correction in growth-oriented stocks. So when we are standing today, and when we look at next 1 year or 2 years, we think now is a time, number one, the gap has reduced to statistically significant level, wherein the new money that will come in will move towards growth-oriented stock. And why so? Because we are also likely near the peak Fed rate or peak of interest rate. And we are at or near the peak. That means that from there onwards, when fresh money starts coming in, they will all enter into growth-oriented stock because valuation has become far more attractive. And when interest rate starts falling, intrinsic value will start increasing, and the growth-oriented stocks will have a much better play, much better chance to perform than what we have seen in last 2022. So I hope I've made this amply clear. This is where the entire world, not only us, the entire world, all those asset managers, investors who had growth-oriented portfolio taken a beating because no one could visualize that Russia-Ukraine war will come in, interest rate will rise so much. Because interest rate rise, a growth-oriented stock, the intrinsic value falls faster because when we apply a discounting rate, the value becomes smaller. And this is going to reverse. Maybe this sometimes in a quarter or so, maybe this quarter or next quarter, when the pivot will happen, when the peak of interest rate is near and that's nearer to us. Thereafter, when the interest rate falls, we will see massive outperformance. Currently, the valuation gap has reduced and they have mean reverted. So from now onwards, we think money will come. Money will have a far better opportunity if they invest in growth-oriented portfolio. And now, again, this is 25-year data from Bloomberg, and this is growth minus value. So if you see majority of, and these are the two outliers, 2022 year was an outlier which growth-oriented stocks had fallen by 22% world over, and we were also down by around 7-8%. So to that extent, we have done a far better job in terms of managing our portfolio, having all those stocks which were resilient, having all those stocks which had a strong bias and had relative strength. So this is where we are in terms of our overall performance. So if someone wants to actually measure us, the correct way to measure is to look at the like-to-like growth-oriented indexes or portfolio, which currently in India, we don't have one. So there are PMS asset. On the PMS side, if you look at, there are hardcore strategies that asset managers run on the growth side. And there also you will see there are people who have lost 20-22% running growth-oriented portfolio. And today where we are, entire world, if you see, all growth-oriented portfolios have taken a beating. So now this is looking at through the lens of index. And as I told you, last 125 years ago, when the index was first invented, had we met at that time, we would have actually, Nirali Bhansali only would have taken this entire presentation by discussing what are the underlying businesses that we have. But anyway, looking at through the lens of index, and the correct way to look at according to us is like-to-like comparison, looking at through a growth-oriented index, and even a 1 year return that you all have seen. Even if we dissect that, the 6 months, the 3 year, the 1 month return, as market is rising and market is improving, we are seeing our numbers getting better and better. So this was all on the bigger aspect. So now let's understand. So basis this last year, in spite of the performance was little below average, we have seen increase in AUM and increase in folios, because people understood that, look, if the portfolio is great, because that is what is going to create that number, whether or not we may perform in a smaller time frame or compared to index. But ultimately, if the underlying portfolio, and this actually is a vindication that people have entrusted their money, people have entrusted their faith that, okay, great, whatever has happened, but we have conviction in your portfolio. And a good part of it that we will describe you in this part of presentation, details of our portfolio. But yeah, I think people have committed their faith, and that's increasing given the number of folios that are rising and the increase in AUM. So is this a good time, great time? Where are we? How the market is heading? What's the kind of return that we will generate? Is it a time when there are global geopolitics will play out? Shall we invest our money? Shall we ask our investors to put in a lot of money? Shall we pause? So let's analyze 3-4 data points that I have, and then we will see. So in January, there was this article which said that in past 6 months, 27 companies with IPO plans worth 38,000 crores have allowed their regulatory approvals to lapse. Meaning, in January 2023, the market sentiments were weak. Merchant bankers thought in their wisdom that this is no good time for IPOs. So let's allow our regulatory approval to lapse. So this is where we are in terms of January. So let's come to February. So little rain in the IPO desert. Again, if you see, in July 2022, there were zero money raised in the form of IPO. Again, in January, there was zero money raised. But if you recollect, last year, June, July 2022, my friends, were a major bottom in Indian markets and world over. So when market bottoms are there are absolutely none or zero IPOs. Currently also last January, February, March, there are negligible IPOs. Meaning what? The meaning is this: the market sentiment is poor. People are not willing to bet. People are not willing to take risks. And therefore, it is all the more convincing that it's now time for to ask our investors to put in money, get more money, because we are the cycle, the bull market cycle is ahead of us. We will see when bull market tops, if you all recollect, there are so many IPOs out there. People want to raise money because the mood of the market is such. Retail investors are excited and they want to buy and they want to enter into at any price, and therefore they subscribe to IPO. But currently it's exact reverse. People don't want to put in their money. People are fearful. People think that recession will come in US market. People are thinking that interest rate will rise further. And that is all the more reason that we should ask our investor to put in lump sum money, because this is where markets are available at lower valuation. The sentiments are poor. And this is when we ask them to invest, we will be able to create an alpha, and we will be able to see the kind of great returns for them going forward. So this was one more in the month. This just 2 weeks back. This is the article that I saw on Mint. And what it says is, are investors losing faith in stock market? 38 lakh investors exit equities. My friend, do you remember this? All these things happen when markets are or at near bottoms, or when sentiments are very negative, or when there is a lot of pessimism. only then and then when you see such type of headlines, or only then when you see investors running away. But when investors are running away, it's time to get into the market, and not we also run away, or we have to tell our investors, look, there is a herding mentality. Majority of street estimate, majority of investors, retail investors are going out. They are fearful. And what Warren Buffett has said, when everyone is fearful, it's time to be greedy. And that's precisely the point. We are at or near that point. These are the times to accumulate aggressively in 1 or 2 quarters, so that when we see a bull market, we will be able to see major alpha in our investors' portfolio. Now, let's understand the underlying fundamentals of our economy. Is India as an economy strong? I think this slide and the next slide says everything. 2 slides, I think, will present the entire picture. This is credit growth rate. So when credit growth rate has increased and now it's at around double digit, please understand the growth is going to come in future. So if Indian corporates are borrowing, if they think there is visibility, if they think there is growth, then only credit growth will happen. And when credit growth happens, the consumption will happen. When consumption will happen, the GDP will increase. And that's how the sweet cycle, or what you call as a sweet circle, will begin, wherein each will perpetuate another. So we think that this is a great time. The fundamentals are strong. Had our credit growth was poor, though, then we could have said that probably we are on the weaker footing. But credit growth is a double digit, and the numbers will come with a lag. And next 6 months, 1 year, 2 year down the line, we will see fantastic corporate numbers, and that's how we think market will thereafter discount those numbers. And one more thing. So this is what in December 2022 that we saw income tax collection. So when direct tax collection are at 26% higher, that means economy at ground level, I think, is growing, economy is vibrant, and even the GST numbers are 1.5 lakh plus month after month, and they are not declining. So these are all the macro reasons we think that our Indian economy is on a strong footing. Investors will currently, because of negative sentiment, they are not investing, but the economy is strong, and therefore we think that these are ideal times to ask our investors to invest aggressively. So broadly, I have covered in my part of this presentation is that numbers, yes, benchmark comparison is one way of looking at it, but the other far more convincing way of looking at it is underlying portfolio. If you are convinced that the underlying stocks are solid, they are great, I think that gives conviction, and that's the reason why we think that we have a great quality portfolio, and Mrs. Nirali Bhansali will cover the portfolio, the stock specific aspects of that. But broadly, I think 1 year is too short a period. But if we dissect 1 year return, we have all sort of great numbers depending on what period we would like to see. But broadly, I think we have, unfortunately, Ukraine and Russia war did not allow our players. So now let me conclude. See, Russia-Ukraine war, no one could foresee, and therefore it was just like a cricket match. We have team of great players, but somehow it started raining. And if it started raining, our player could not perform. Similarly, because of war, interest rate increased. Because of interest rate increase, the cost of money increased. And when cost of money increased, all the growth-oriented stock, our players, they did not perform, because by very nature, by very economics, the intrinsic value falls, and that has happened to not only our portfolio, but across the world. Still, we have done better when we do a like-to-like comparison, when we do growth-oriented portfolios. So yeah, thank you, and over to Nirali.
Thank you. Just allow me to share my screen and then we can continue. Yes. Yes. Hello, everyone. Firstly, thank you for taking out the time and joining us today. So today we will cover a lot of things and a lot of insights, basically. Firstly, I will take you all through our entire thought process, the details of the fund and our strategy, basically, that we followed in the past entire year. Going ahead, also, I will take you all through what our strategy is going to be like, and also the fact that what we expect from our businesses going forward. So we have conviction in the stocks that we hold, and why we have that conviction, what is this confidence that we have in these businesses, and what do we foresee from them going ahead, maybe 1 year, 2 years down the line. That is exactly what I will take you all through. So firstly, let's begin with the portfolio update. In this entire year that we have finished as a flexi cap fund, there have been very, very minimal entries and exits. So we have taken very tactical decisions as well as structural decisions. Why do I say that? It's because we believe in the compounding story of businesses and we want them to compound. So we don't want to jump the bus just because something is working in a shorter period of time, or just because something has run up and is going to go up in a very, very small period of time. That's not how we look to create wealth for our investors. So therefore, we look at it from a longer perspective. We look at the compounding story, and that's how we decide what churn we want to do in the portfolio. So there were tactical decisions like Intuit and Nvidia. That is basically initially from on the foreign equity side, we had around 8 stocks initially in the fund, but we decided that there is a $7 billion industry-wide limit, and that limit was about to get breached, and all mutual funds had been told not to invest in foreign equities further. So we couldn't increase our exposure there. So we decided to reduce the number of stocks that we hold since the exposure would remain the same. So we exited Intuit and Nvidia completely because of that reason. Muthoot was more of a structural issue because we saw the competitive intensity was going up. So that was the reason, the first crack that we saw, we completely exited Muthoot from our portfolio. And on the other hand, we added 3 new stocks, Godrej Consumer Products and Aditya Birla Capital. We believe are turnaround stories with a lot of potential for growth in the future. Balkrishna Industries, again, an exposure to the auto component sector, very, very secular stock where we believe that there is future potential for growth and the compounding engine is really running strong. So this was our main decision in terms of entries and exits in the past year. But having kept the entries and exits to a minimum has actually helped an investor. Why do I say that? It's because all these costs when we buy or sell a particular stock, that gets added as a cost in the NAV, and it actually impacts the unit holder. So therefore, when we keep this to the minimal the cost, the NAV falls down further, so to speak. So this was our thought process as well, and it has benefited the investor because we have kept our cost to a minimum. Having said that, our Samco Flexi Cap fund today has an exposure of around 97% to Indian and foreign equities. Indian equities around 92%, 5% to foreign equities, and we hold around 2.4% in cash. It is still a very, very diversified portfolio. We have around 26% exposure to IT and technology. We have around 24% exposure to finance, around 7% odd exposure to consumer durables, 7% to FMCG. We also have around 9% exposure to pharma and healthcare. Even if we see on a subtext sector basis, we do have auto components, we do have chemicals and petrochem around 4%. We have QSR, which is around 4% again. So it is a very, very diversified portfolio in terms of the industries and the sectors. We also have a market cap which is very agnostic, as in we are market cap agnostic because our large cap exposure is 55%, mid cap is 31%, small cap is 10%, and TREPS, as I told you, is basically cash, which is 2.4%. So we are a truly flexi cap fund, and we want to maintain it that way and not really juggle in terms of having a very, very skewed percentage or weightage to one particular market cap. And instead, we want to be very well diversified. So that has actually helped us. And as Mr. Umeshkumar Mehta said, that we do believe in holding a portfolio which is true to its word, that it is an active portfolio. So our active share stands at 90%. And what has helped this, and why have we been able to maintain this? It's because if you compare us to the benchmark, you will see that in the top 10 constituents, there is only one stock which is common, and that is TCS. So TCS in our portfolio is around 8%, but in the benchmark, it's only 2.99%. So you can see that it's not that we are copying the benchmark or we are hugging the benchmark. We are actually giving you a portfolio which is different than the index, and that will actually help you create alpha in the future. There is another factor which has helped us to maintain this high active share, and that is we do not really have exposure to metals, oil and gas, power, telecommunication. All these stocks are present in the benchmark, which is Nifty 500, but it isn't there in our portfolio. So due to these reasons, we have been able to maintain a very, very high active share, and we intend to continue doing that in the future as well. So this was all about the portfolio update, but now let me take you all through the main part, which is the strategy. So you all must be aware how money flows in the market, or stocks basically are influenced by a lot of factors in the short term. Like on a day-on-day basis, you can see that there is sentiment, there is news, there's analyst expectations, and there is FII and DII flows. So we have taken a holistic picture. We do take a lot of macros into account before we rejig the portfolio in terms of its sectoral weightages. Why do I say that? It's because once we use a bottom-up approach to select the particular stocks where we see a very, very huge compounding to play out in the portfolio, we also look at the macro situation. We also look at what the FIIs and DIIs are doing. How is the sentiment going to look like? And that's how we kind of move our sectoral weightages. So let me give you an instance. IT, software and services, which is basically technology stocks, they had definitely taken a beating back in June, and till September, they were moving around the same range. But that's where we saw that there was stability. There was some point where it kind of took support, and that's when we continued to add. So that's our strategy. When markets correct, or when a particular sector or a particular stock corrects, that's when we add more. And why is that? Because we are not here to make a portfolio for tomorrow or just for the next week. We are here to create wealth for an investor, at least from a 3 to 5 year horizon, because that's when you will see the returns that you deserve to have. So you just need patience. And we are definitely following this strategy that whenever markets correct, we are actually adding, and that's how we are averaging down our costs. So this has been helping our portfolio, and you will see the benefits of this kind of a strategy a couple of months, a couple of years down the line. So this is exactly what we have been doing on one side of the curve. But if you see on the other side, that is what has already gone up. For instance, chemicals have definitely gone up. Over there, what we do is we kind of reduce our exposure. So you can see this exposure has come down. So if something has definitely gone up, we reduce our exposure. If something is down, it's attractive. That's when we add to the exposure. So this has been our strategy. And more so, in a shorter time frame, what has happened in the past year, or why have we taken the hit? That's because money has actually gone towards PSU banks, it's gone towards CPSE, it's gone towards CG, all these kind of sectors or indices. And it has gone out of technology, financial services, which is where we have majority exposure. But does that mean that in the short time period, just because things are not moving in that direction, we should just exit the stock? If there is fundamental strength, if the underlying engine is on, you have to give it time. Because in the long run, you can see this is the impact, or this is the returns that they deliver. Or if you take a 5-year performance of IT index, or the services space, or the finance sector, you will see that majority of the returns are through these secular kind of stocks, or these secular sectors, or secular industries. And that's why we continue to hold them, and we do not just jump the bus from because of a couple of months of movement. So this has been our strategy. And even if you look at it on a month-on-month perspective in the past entire year, you'll see very clearly, like the financial service and IT sector, there have been outflows. But after June, you can see that there have been green shoots as well. So there is money which has started to come back in. And we see a lot of tailwinds in the sector in a couple of months. But by then, it shouldn't happen that the prices have already started moving and you miss the bus. So it's very, very important to catch these companies while they are very attractive. And we feel that IT, financial services, especially the companies that we hold, are in a very, very good space currently. Having said that, this is definitely one way of looking at things and how we look at things. But there is another factor that we do consider, and that is the US markets, because at the end of the day, US markets do have an impact on the Indian markets. And let me show you what we have been looking at. So NASDAQ 100 is the technology hub, so to speak, in terms of indices, because it consists of the 100, it consists of a lot of majority of the weightage to technology stocks. So if you see back in May, June kind of a situation, so around June, what had happened was markets had definitely corrected. But this line shows you the 52-week lows. And there were so many stocks which had made 52-week lows over here. It was among the highest over here. But after that, what happened was, as markets continued to move ahead, the number of stocks making 52-week lows started declining, and dramatically. This just shows that the breadth of the market, in fact, has become stronger. The stocks weren't willing to go down further. So there was some kind of stability. So that was the time, in fact, you see, you kind of accumulate further, because you can see very clearly that the breadth is not weak. You can see that markets could turn around. See, nobody can predict the exact bottom or the exact top, but you need to analyze these indices to actually create a rough picture in your mind that this is a very good valuation for the stock. This is a very good time to accumulate further and not get worried that we should exit the portfolio. So this is what we look at in terms of global indices. We also saw the NASDAQ Composite Index, which covers over 3,000 stocks. So if you see the NASDAQ Composite Index and you see the number of stocks making 52-week highs, here was the time, so around 2021 end was the time when there were a lot of stocks which made 52-week highs. But after that, the entire year, there was nothing. It was not that there were so many stocks showing strength, but now back in 2023, you can see very clearly that at this point, the stocks have again breached this same gap and made 52-week highs. So that also shows strength in the NASDAQ Composite Index and the stocks which basically are a part. So majority of the stocks are, again, a lot of technology stocks in the NASDAQ Composite Index. So all this definitely gives us conviction in the stocks that we hold, the sectors that we hold in our portfolio, because we know for a fact that they have faced correction. But now is the time that you accumulate, you continue to accumulate, because the fruits will be reaped after some months, definitely after a couple of months. So this was our entire strategy, and we continue to hold this strategy going forward as well. That was the broader strategy. But now there is a very important approach or discipline that we use internally to pick stocks in the portfolio, and that is our E3 approach. So the first leg of the E3 strategy is we buy efficient Hexashield tested companies, and our portfolio, if you see, continues to remain very, very strong in terms of quality. Our adjusted return on capital employed is 32%, whereas our benchmarks is 21%. So despite all the pressures in terms of inflation, the interest rate hikes, even after that, you can see the clarity in the quality of these businesses, that these businesses haven't been hampered in any manner. So we have actually stuck to our strategy. We have picked quality stocks and we have not diverged from what we had initially promised. Our second leg was that we will buy them at an efficient price. Now, as I told you, these are quality businesses. There's nothing which has gone wrong in terms of quality. There is always a premium that you pay for quality. And that is exactly what we have done. Whatever at price we have bought, we find it that it was justified because the growth engine was on, because there was a lot of reinvestment of cash flow that is happening, which will help you compound your return on capital employed going forward. So this valuation is very well justified in our opinion, and therefore with our adjusted FCFF yield at 1.9%, Nifty is at 2.8%, we are very, very comfortable, and we feel that it is an efficient price that we have paid, and we have stuck to our strategy. Thirdly, as I already showed you all, we have kept a very minimal churn in the portfolio, and our cost structure has been handled and managed very well because it's to the minimum. So our E3 strategy is still intact. We continue to follow this in terms of our bottom-up approach of picking stocks. And that is what has helped the portfolio till now and will also help the portfolio going forward. Now let's get into some more insights in the of the FlexiCap fund and get into the stocks basically. So we hold 25 stocks in our fund, in our portfolio till date. But in the past year, let's see what has worked for us and what has not worked for us. So our top 5 contributors in terms of performance have been Aditya Birla Capital, Supreme, JB Chem, Novo Nordisk, and Pidilite. So they were our showstoppers, so to speak, in terms of performance. But there were 5 very big detractors for us: LTTS, Meta, TCS, Crompton, and Divis. So in the entire year, these 5 stocks have been our top losers, so to speak, top detractors. But even after that, we continue to have the conviction in the growth story of these stocks. And we see that there is a lot of potential for growth from here onwards as well with these businesses that we hold, because structurally, there is nothing wrong with them. And it's just a cyclical play which has worked in the markets, and therefore the prices have corrected. And when prices correct, but fundamentals are intact, in fact, that's a doubly attractive opportunity to invest in these stocks. So that is how we look at these 5 businesses. Let me give you some more details and take each stock one by one and explain what we look at them and why we feel that going forward, there's a lot of potential for growth. So their growth story has definitely not been hampered. Let's see why we hold them. First, let's begin with LTTS. So LTTS is the major player in the ER&D space, which is nothing but engineering R&D. And in this industry, in this sector, what happens is NASSCOM, which is a non-profit organization, it has said that it will increase its spending in this for this particular sector by almost 16% CAGR. So all of this money or expenditure is definitely going to help a player like LTTS, because there are not many companies in this sector. So LTTS has very, very minimal competitors, and it's one of the largest players in this ER&D sector, even in the technology space. So with this commitment of expenditure, LTTS is definitely going to benefit from here onwards. And even if we judge LTTS in terms of its key parameters compared to pre-COVID levels. So December 19 was a pre-COVID date. And now if we see, so let's compare margins. Pre-COVID, 20%, today 22%. And y'all are aware of what kind of pressures we have seen in the IT sector in terms of wage hikes. There have been attritions, inflation is definitely up. Despite all of that, margins continue to grow. It's $10 million client. You see the number from 20 has risen to 24. So therefore, you can see that there is demand. It's not that demand has gone down. Total revenue from 1,400 crores pre-COVID gone to 2,000 crores. So you can see again that demand is there, order book is there, order book is intact. It's not that the top line is being affected. And the EPS, which is the main thing that you see in terms of what trickles into the bottom line. 19.6 rupee per share pre-COVID has jumped to 28.8 rupees per share. So structurally, you can see very clearly, nothing has really gone wrong for TCS, for LTTS, but the prices have corrected. So isn't this the time that you accumulate more of these kind of stocks? So this is exactly what we believe that the company can also continue to do going forward. So therefore, we continue to have conviction in LTTS and we hold it in the portfolio. Coming to TCS, which has also been a detractor for us. TCS, as you can see, the street definitely expects, as the largest services player in the IT sector, the street expects this $25 billion of top line to grow twice. So 2x growth is expected by FY30E. You can see when this trickles down to bottom line, and we did some math and some back calculations, the EPS would grow by 14% CAGR, year after year after year. So 14% CAGR. And this EPS growth, as Charlie Munger also says, that if the underlying engine delivers a high return on capital employed, delivers high growth, your prices in the longer run converged with this growth. So your prices kind of reflect the same kind of growth. So if EPS would grow at around 14%, and you all are aware, dividends and buybacks are definitely TCS's thing. So in FY22, 50,000 crores were given to shareholders by way of dividend and buybacks. And this number would, if the number continues at this rate, it would be a 4 lakh crore that shareholders would get in terms of dividends and buybacks. So that would be a yield of 1.3%. So 14% EPS plus 1.3% by dividend and buybacks, that is around 15.3% of yield or returns that or growth that actually a shareholder would witness in TCS. And as I already mentioned, the prices converge to the underlying business's growth. So that is where we would also expect the price to be. And that is why we hold conviction in TCS's growth story. There were also some mathematics done behind buybacks, and we did some research as to historical buybacks, how they have been behaving, etc. And what we noticed was very, very interesting, that 3 months before a buyback is announced, what happens is the stock price jumps by around 20% odd. So this was what has happened historically, and we would be really delighted that this happens in the future. But this is not a promise. This is something that we have observed, and we feel that this is likely to play out in the future as well. So therefore, because of these reasons, we are really, really attracted towards TCS, and we feel it is a very strong growth story that we should definitely hold in our portfolio. Coming to the next detractor, which is Divi's Labs. Now, Divi's Labs is basically into custom synthesis and the generics business. If you see its quarterly revenue trend, because custom synthesis is a very, very lumpy business, what happens is on a shorter time period, like on a quarter-and-quarter basis, if you see the company's revenue, you will see that there have been times when it's declined. It's not the first time that it's declined. There have been times here, so it's innumerable times that it's declined on a quarter-and-quarter basis. But if you take a step back, look at the bigger picture, you will see that this trend is definitely very secular, there is a lot of growth. You can see that it's rising continuously, and there is no issue in the business. Custom synthesis, which is the higher margin business, is in fact expected to receive a lot of orders. Why do I say that? Because there are new opportunities in phase 3. There are a lot of other opportunities going to come by big pharma. And even in the generic space, which is the other 50%, there are a lot of drugs going off patent in the next 2 years, which are going to be of benefit for DV slabs. So from a future growth perspective and its existing core business, there is nothing wrong with the business. The current negativity that you see, the current price impact that you see, that is because of a one-time drug which was there during COVID. But now all of that is priced in, all that negativity is already in the stock, and the margins are in fact at a rock bottom. So we feel that from here onwards, it's just going to go uphill, and we continue to have a lot of faith because Divi's is the largest, the lowest cost producer in India. It is the largest exporter in India in APIs today, with very high barriers to entry. So it doesn't have a lot of competition, especially in the API space that it is. So we have a lot of conviction in a stock like Divi's Labs. And despite it being a detractor, we continue to hold it in our portfolio. Coming to the next stock, which is Crompton. Now, Crompton, if you observe, in terms of its competition, in terms of the other players in the industry, Crompton continues to be a leader in the sectors, in the segments that it has. And the current movement in terms of the price was more because of the industry pressure that industry as a whole received, and it was not something that that was because of an issue or a business related issue or a structure related issue in Crompton itself. Why do I say that? It's because you observe its margins. Yes, on a Q-on-Q basis, there have been some degrowth in their margins, but it's happened with Havells as well, with V-Guard as well, with Orient as well, Bajaj also. So it's not that it's just Crompton which is the problem. There was weak festive sales, there was rural pressure. Because of all these reasons as well, the entire sector has suffered. But we feel that going forward, there are a lot of tailwinds for this sector because, as the managements themselves said, so not only Crompton, Bajaj, Havells, every management also feels that going forward, definitely there's going to be a higher temperature summer, which is going to come. There's going to be a lot of demand going forward. Inflation at one point in time will definitely abate, and sooner than later, it is going to happen very soon now. So there are a lot of tailwinds now for a consumer durable sector, and we feel that Crompton from these levels is looking very positive, is looking very bullish, and we are very, very confident that this story will also play out for us. Coming to the largest holding, one of the largest holding that we have in the portfolio, which is Bajaj Finance. I'm sure many of you all would have questions on Bajaj Finance, but let me tell you our side of the story, why we continue to have this kind of faith or confidence in Bajaj Finance. Not getting into what the business does, because I'm sure everyone would be aware about it by now. But let's compare Bajaj Finance to the largest private sector bank, which is HDFC Bank. When you compare these two, what you see is that Bajaj Finance's CAR is still around 25%, HDFC Bank's is 19%. So there is a big gap. Even if you compare other banks to Bajaj Finance, what has happened is, in the past couple of years of growth, Bajaj Finance has definitely grown by around 40% in terms of AUM. But at the same time, the other banks have grown by around 20%, 18%, and much lower. So if you compare these two, you can see very well that the fundamentals for Bajaj Finance compared to banks remain very strong. Even if you see what kind of lending it does. So Bajaj Finance does a lot of lending into different sectors, for different sectors, different industries. And it continues to have around 45% market share in personal loans, whereas banks on an average have around 40% exposure in terms of personal loans. In commercial lending, Bajaj Finance has around 23% exposure. Banks together also have around 20-25% exposure. So what is Bajaj Finance not doing that the banks are doing? It is doing everything that the banks are doing and giving you better fundamentals. So we continue to have very strong conviction in Bajaj Finance. And even if you compare Bajaj Finance to the other NBFCs out there, you can see In terms of AUM CAGR, Bajaj is at 19%, other three NBFCs at 7%. ROA is much higher, 3%, others at 2.55%. ROE is also 18%, others at 16%. CAR definitely higher, NNPA is much, much lower. So Bajaj Finance, in terms of fundamentals, in terms of growth, we do not see any issue. And why is that? It's because it has created a moat for itself. It has a diversified AUM, and the important aspect is it is a data mine. So this data mine, this investment that it continues to do in IT actually will help it to do a lot of cross-selling, lot of upselling in the future. So we remain very, very confident on Bajaj's story, Bajaj Finance's story, that it will continue to grow, because at the end of the day, it is still a growth machine. So what the street also expects is similar, to be honest, because this is not only our assumption, this is taking all the analysts, all the street expectations into account. So you can see AUM, if it grows by around 38% from a 2 lakh crore to a 4 lakh crore in the next 2 years, that translates to a book value per share of a CAGR of 23%. And if you put this book value per share into scenarios and look at it from a bearish scenario, which is at maybe price to book of 4, and take it up to a bullish scenario, a very, very bullish scenario for 12 times price to book, which is where it has actually reached, you will see that there is still a lot of price CAGR, even on a bearish side, even on a most bullish side, that is left in this stock. So in terms of price, in terms of compounding, we are very, very strong. We are very, very bullish that and confident that Bajaj Finance will definitely be one of our top winners for us in the portfolio. Coming to the next stock, which has also seen a lot of negativity, and it's experienced a lot of price correction, which is Jubilant FoodWorks. So Jubilant FoodWorks, even though the inflation picture was, inflation is high, what has worked for Jubilant is it can always reduce its ad expenses and increase its PBT going forward. So there is a lot of cushion there. If you compare Jubilant with the others in the sector, you can see very clearly it still has the highest number of stores. So the revenue per store count, etc., we feel that going forward as well will be very, very strong for this particular QSR player. And it's been able to manage its ROC very, very well. So even after this, its average ROC has been 25%. So again, structurally, business perspective, core business is intact, no problem at all. There is another very important thing that is happening in Jubilant FoodWorks. So if you see this phase from 2013 to 16, this was the time when there was a lot of capex that was announced in Jubilant, around 763 crores of capex. Plus, they had declared that they would add around 531 new stores. After this consolidation phase, or after the capex which got implemented, what happened was the benefits of the capex kicked in, and that's when the stock price shot up. So we are now in a very similar kind of a situation where there is almost 1,600 crores of capex that is announced, and they intend to add 300 more stores in just 12 to 18 months. So this kind of a movement in stock price is what we expect from Jubilant once this capex kicks in. And therefore, we see a lot of growth potential from Jubilant FoodWorks going forward as well. So this was all about the stocks, where we are trying to tell you that the story, the fundamental story is not hampered. There is a lot of future earnings potential from the stocks that we hold, and therefore we continue to have them in the portfolio. So let me show you a more comprehensive picture of the fundamentals. As a portfolio, if you check our non-financials, you'll see that Samco Flexi Cap Funds ROC is at 30%, whereas benchmarks is at 21%. ROIC, if you see 26% last fiscal year, Nifty's is at 10%. Our gross margins, despite the pressures, the inflationary pressures, the commodity pressures, you can see LTM is 64%, Nifty's is at 42%. Debt to equity, again, very, very less, 0.2. Nifty's is at 0.53. And our sales growth and PAT growth have also been very strong. If you see our financials, pre-tax return on equity and CAR, both are very strong. And compared to that, Nifty's is at 18%. So from a fundamental perspective, we do not see any issue. The story continues to remain strong. Now, this is a very interesting street estimate that we wanted to show you, because this is something where all the analysts, where all the basically analysts in this community or industry are trying to forecast and see where these businesses or what these businesses would give, or what will be the growth story from 2 years down the line. So this is a street estimate that we have taken from Refinitiv, where they predict that suppose, for instance, Pidilite's EPS growth is going to be from 26 rupees per share. It's going to jump to 43, which is a 28% compounding in 2 years. So similar to that, when you check for all our businesses and when you put the weightage of 31st of February, you will see that on an average, we can generate, as in the businesses that we hold can definitely generate almost a 19% average weighted EPS growth. So this is what the EPS story will look like for our businesses, that we also expect them to grow in terms of EPS. And as I already mentioned, the price will definitely follow. So price is a slave of earnings. And with this kind of growth in EPS, we feel that the price will definitely catch up. So that is how we look at our businesses. And let me get on to the valuation. So this was all about showing you all why we are so convinced, why we continue to hold the stocks that we hold in the portfolio. But now let's look at where we stand today. So even today, if you see this pink line tells you the weighted average price to equity for our companies, our businesses. Compared to that, you see this yellow line, that is the 3-year weighted average. So the average currently is lesser than the 3-year weighted average PE. So what better time to accumulate such strong fundamental quality stocks than now, when valuations are also very attractive. So underperformance of heroes have to be looked at as buying opportunities, and this is the time to continue to accumulate. Let me show you this with some charts, because charts are sacrosanct at the end of the day, because we're all running behind price, right? So let me show you this same thing in terms of the chart. This is Bajaj Finserv's chart. The upper chart is the price chart. The lower one is the quarterly EPS growth that you see in these businesses. Over here, you can see EPS has continued to grow, but the prices has corrected. So this was the time to pick up a Bajaj Finserv, which is exactly what is happening right now. The EPS is growing, but prices have corrected. So this would be the time to accumulate Bajaj Finserv. So this is how you have to look at it, that EPS is still growing. There's nothing structurally wrong with the business, but prices have corrected. That means you accumulate. Bajaj Finance, very similar story. EPS is still growing. This was the price correction to accumulate. Over here as well, earlier in 2020, it had fallen down, but EPS was strong. So then you can see this price jump. Because EPS was strong, the prices caught up. So this is what we are trying to say with the businesses that we hold. Tata Consultancy Services, TCS, again, you can see the EPS has continuously been growing. The price had corrected here, but after that, the price definitely picked up. Here again, it was a similar situation where prices had corrected, but EPS story is still on. So the prices have to catch up. LTTS, as I already said, EPS growing continuously, run rate is very strong. Here prices had corrected, but after that you can see the returns that it delivered to investors. So we are in a similar situation currently, but EPS is very, very strong. LTI Mindtree, again showing a very similar picture, that here prices have corrected, but EPS is growing. So we all know this is what is going to be in our next couple of months or couple of years in the future. So this is how we should look at stocks, even when we are looking at the charts, and not really time them from a day on day or a week on week perspective. So yes, the best way to measure your investment success is actually not by beating the benchmark, but you should know that if you have a financial plan, if you have the behavioral discipline, then that is actually going to take you a long way ahead, and it is actually going to get you where you want to go. So we really believe in this philosophy. We believe that it's not about beating the market on every very, very short-term time horizons, but it's actually sticking to our plan, sticking to our strategy, and maintaining the discipline that we have in the portfolio in terms of our strategy. And only this will take us a long way ahead in terms of the returns we can deliver, the returns we can generate for our investors. So we are very, very confident that this is the strategy, this is our discipline, and we are going to continue having this discipline in the portfolio, and continue to keep this strategy going forward as well, because we are here to, as money managers, as asset managers, to create wealth for an investor. So yes, this is just a statutory mandatory requirement in terms of returns, riskometer, etc. But we can get on with the questions, and if you all have anything, please feel free to ask us. Thank you.
Thank you so much, Nirali. Thank you so much, Umesh sir. We received few questions today on the chat box and also over the mail in previous few days. Most of the questions were revolving around performance of our fund, and few stock-specific questions are addressed during the call itself by Nirali and Umesh sir. So thank you for that. Thank you for attending this call, and we will keep our efforts higher for selecting high-quality portfolio for our investors. Till later, signing off, Janvi Adzgaonkar from Samco Mutual Fund. Thank you once again for your time and effort to hear us. See you guys soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.